welcome. Today I'm going to show you how you can purchase bonds in StockTrak, and first we're going to take a quick look at the terminology that you need when you buy bonds. So we have two very important concepts, that is par value or face value and the coupon rate. When you buy a bond, you lend money to the company, and because you lend money they promise to give you a payment back, and this payment can come in two different ways. You can either get a par value, or you always get a par value, and that is a value that you get at the end of the bond's maturity. So the bond has a lifetime, let's say it's 5 years, then it matures in 5 years time, and at that maturity date you get the amount that is given in the par value. So if the par value is $1,000, that means that you get a payment of $1,000 as the bond matures on the maturity date. The other payment you can get is a coupon, and in the US the coupon is usually paid twice every year, and the coupon is you usually express it as a coupon rate, and a coupon rate is the percentage of the par value that is paid to investors each year. What this means is that if you have a coupon rate of 5% and you have a par value of $1,000, that means that the yearly coupon would be 5% of $1,000 or $50. Since you pay it twice every year, that means that every 6 months you get a coupon payment of $25 in this case. Okay, so if we go to StockTrak now, from the main page you go to trading and then you choose bonds. When you trade bonds, it's slightly different from when you trade stocks. First of all, you only have two actions. You can either buy a bond or you can sell a bond that you own. And secondly, you do not have to write the company symbol because you only have a limited amount of bonds to choose from. So you need to begin by selecting the type of bond. You can either buy a corporate bond or you can buy a treasury bond. And I'm going to show you both in this case. So if we choose the corporate bond first, then you get the list here of all the bonds available to you. So as you can see, you have a few different bonds to choose from, but compared to the amount of stocks that you can choose from, this is really not that much. Now, in the name, you have most of the information that you need. Here on Adobe system, you can see the percentage 4.75%, that is the coupon rate of this bond, and February 2020 is the date that this bond matures. So from today, it's roughly 6.5 years until this bond matures. Now, if we would click on this one, you get a little bit more information. You can see the last price paid, the value of the bond, and you can also see the par value, that in this case is $1,000. So this means that every year you would get a coupon payment of 4.75% of $1,000 or $47.5. And if it's paid twice every year, that would mean that you get $23.75 every 6 months. Okay, so how should you choose bonds then? Well, there are of course quite a few different ways to decide which bond you would like to, but for example, you could decide that you would like a high coupon rate or a long time to maturity, or a low coupon rate or a short time to maturity, or you could even try and compute the different yields on these bonds. And then you should be aware that a higher yield usually means that the bond is more risky, that there is a higher risk of default, so you get nothing, or at least not all of your investment back. On the other hand, a low yield would mean that, okay, it's less risky, but you do not expect to gain that much if they do pay out. If you do not want to compute the yield, I'll give you some page reference later how you can do it. But if you do not want to compute it yourself, you might want to look at the credit rating given by the credit agencies, like Fitch or Moody's. And then it would usually be that the lower the credit rating on these different companies, the higher the yield should be, and the higher the credit rating, the lower the yield should be. But I'm going to stick to the information I have here and make my decision based on the coupon rate or the time to maturity. So I'm going to begin with the corporate bond, and I'm going to require that the corporate bond has more than 5% coupon rate. So that's a minimum for me, and this is taken for no specific reason, just to have one example. And then I'm going to choose the bond that has the longest time to maturity. So if I go back here and I will not look at, for example, this one, Adobe system, because it has not a coupon rate above 5%. but I could look at Ultra Group Incorporation that has a quite long time to maturity since it doesn't mature until 2039. Now, if I would look through all of this, I would find that the one that fits my profile, more than 5% coupon rate and the longest time to maturity, is Boeing, that has a coupon rate of 6.875% and that matures in October 2043. So, I take this bond, I wait to see the price, and then I decide the quantity that I would like to buy from it. I'm going to assume that the price is above $1,000 because it probably has a par value of 1,000, and if that's the case, then I would like to buy 50. Okay, there we go. Okay, so the price is for $1,429, then 50 sounds like quite a good amount to buy. If I look at the order here, I can see that this would cost me approximately $72,665. Okay, that sounds okay. So I place the order. Alright, and now I've purchased a corporate bond. I also want some treasury bonds given by the US government. And here we basically have two different types of bonds. We can either buy T-notes or we can buy T-bonds. And the difference is that the T-note is no longer than 10 years and the T-bond is has a longer time to maturity than 10 years. There are also T-bills that you could purchase, but they're not available in StockTrak, unfortunately. But you can still trade them through ETF trade, exchange-traded money market funds, which I show in a different movie. Okay, so these are the different bonds that we could purchase. And when it comes to the treasury bonds, I'm going to have, in both cases, whether it's a note or a treasury bond, I want them to have more than 3 years to maturity. And then when I buy a treasury note, I'm going to take the one with the lowest coupon rate, and when I take a treasury bond, I'm going to take the one with the highest coupon rate. This way I can see later on how maybe changes in the interest rate has affected my return. Okay, so in treasury note, I wanted one with a maturity that is more than 3 years. So I have to look at 2016. And then I want one with the lowest coupon rate, which turns out to be the one with 1.0% that expires in October 2016. Okay, so I select this one and I buy 30 of this one. Okay, that will cost me approximately $30,000. That seems fine. So I place the order. And now that's done. Okay, and then for the last one, I wanted a treasury bond. And here I would like the one with the highest coupon rate, which turns out to be the one that expires in 2024 and has a coupon rate of 7.5%. Okay, so I look at this one and I see that the price is $1,591, and let's say I buy 20 of this. As you might have noticed now, the price of this treasury bond was much higher than the one of the treasury note. That is not because it is a longer time to maturity, but because the coupon rate is higher. So in general, the higher the coupon rate, the more you're going to have to pay for the bond. Of course, this is only true if you look at, for say, the same company in the same maturity, but when it comes to treasury bonds or treasury notes, it's probably going to be more or less true at least. Okay, placed order, and now I purchased a treasury bond, a treasury note, as well as a corporate bond from Boeing. Just as with stocks, I'm going to include information on these. So on the corporate bond, I say that, okay, I would like the coupon rate to be above 5%. Of all the ones that had more than 5% coupon rate, I choose the one with the longest time to maturity, and this was for no specific reason. The bond I did purchase was Boeing. The coupon rate was 6.88%. It matures in October 2033. The type, this is something that I did not have in the stock movie, but I'm going to include it in just a second also for the stock. The type is a corporate bond and the asset class is bonds. So this is really the important part. We need to know what asset class we have, because later on you're going to make an asset allocation pie, and then you need to know what is stocks of the assets I have, what are bonds, and what are money market instruments. So in this case, the Boeing bond was a bond, and the same goes for the T-note and the T-bond. The asset class are bonds, and the type is T-note and T-bond. And here are the information of the those two bonds, and also the criteria that I had and the purchase decision. I'm just going to fill in the information on the stocks. Here we had the type of stock and the asset class or stocks. This might seem a bit redundant to write the same, but when we include the funds as well, then there's going to be a difference, because the type then would be maybe a fund or an exchange traded fund, and the asset class could be a mix of stocks and bonds or money market instrument and bonds perhaps. Okay, now if you would like to read a little bit about bonds before you start trading with them, you can read about the bond market on page 62 to 69. They discuss treasury notes and treasury bonds on page 62 there, and corporate bonds are mentioned on page 66 to 67. These are page references to the chapters that are included in the course, but if you are a little bit more ambitious, you might also want to read chapter 14, and then especially section 14.1 that discusses bond characteristics, section 14.2 that explains how to price bonds, and section 14.3 where they discuss how you can compute the bond yield or the bond's return. So, just to be absolutely clear, this is currently not included in the course, but this is, as I shoot this film, it's 2013 in August, so if it's included in the future, then this maybe not extra page references. But currently it is, so this is only if you would like to know more about bonds. And if you're interested in using Excel, then we have page 478 and 480, where the book includes Excel applications to find bond prices given a yield, but also how to find the bond yield if you actually have the price, as is the case here. Alright, so that's it for today. I hope this helps you to choose bonds. Thank you very much.